what I want to accomplish today, three things, maybe four. Want to talk about, let's just say, valuation, basics, maybe for, I don't know, 20 minutes, 30 minutes. We'll do some like warm-up exercises. And then we'll think about, okay, let's do a case walkthrough. And there's two methods that we're going to focus on. One is DCF. This is time value concept. And then the other one is finance people like this one because it's very concrete. We crunch the numbers, we get definite answers. And then, well, there's a lot of underlying assumptions. So we could tweak those things and we can run multiple scenarios in Excel and we can make a football chart. The football chart just shows you the range. So we ran it with certain assumptions about this number and the valuation was lower. We ran with certain assumptions, valuation was higher. DCF, that's the crunching numbers, popping all this stuff. So I'll see how we're feeling about it because there's we also need to kind of work through this thing called capital asset pricing model in order to get the finance guys like their acronyms. Earnings multiple is much simpler, and it's probably, I'm going to guess this is kind of the way valuations are probably talked about more in the business world, especially amongst people who aren't like finance experts. But you kind of have to know them both. And one of the reasons we want to do two is it's like a robustness check. We want to check the one against the other and see if the numbers are close. Because if we do both of these and the numbers are really far apart, it's like, there's something we don't know. There's assumptions that are wrong. It smells bad, and maybe we don't want to do the deal. We're doing both. We really scrutinize our assumptions. We see that those numbers are pretty close, and then we say, okay, so we got a baseline. It's like when you're going to buy a used car. Like, I got a certain amount of money I want to spend. I got a certain criteria I need to get. We know that, and then let's go see if we can find the deal. And if the price is too high, what do you have to do? You have to say no. You have to walk away, right? You have to find another deal. And that's an important thing. You can't get emotionally attached here. Sometimes there's like family business things, and somebody wants to sell the business, but somebody wants out of the business to go retire on a yacht in the Bahamas or something. Seriously, they make up these really in-depth scenarios. It's really amusing. But you are the consultants that are hired to run the numbers and evaluate this and then go give professional advice. And you've got to, if it doesn't work, you've got to tell them no, right? If it looks good, you tell them yes. If it's in the middle, you say, well, maybe. And here's the assumptions that are critical in making the valuation higher or lower relative to the price you want to pay. So what is this all about to begin with? M&A. Anybody seen that term before? So, okay, kind of knowing the terms and stuff is half the battle. But anyway, what are we talking about when we're talking about M&As? Who knows that? Yeah, you got it?
Mergers and acquisitions.
Mergers and acquisitions. So we're talking about buyouts. We're talking about a business wants to buy another business. We're talking about a business wants to sell itself because the owner wants to retire or whatever, right? So when you're looking at mergers and acquisitions, a business is going to get bought, and that means the business is going to get sold. The buyer wants to make sure the price is good and for what they're getting. Seller wants to make sure the price is good for what they're selling, right? So we need to set up a price. So this is basically an appraisal exercise. When we talk about valuation, you can think of that as appraisal. It's a little bit different than a appraisal you might be familiar with. Like, what do you get appraised? A house. Antiques. Yeah, there you go. I got maybe a car. Like, I want to sell this car. What's it worth? It's more than an appraisal because it's not just an asset. It's not just an item. It's an earning asset, right? A business, an enterprise. So we need to figure in all those factors when we do the valuation. Here's how much they earned last year, but how much could they earn next year if we made some changes based on wise management procedures, for example? Okay, so it's an appraisal, but it's a really kind of complicated and in-depth kind of appraisal. So that's what ACG covers about. We've got a business that we have to value. Sometimes we have to value more than one business because sometimes it's a investors who would say we could buy that business or that business. Value them both, tell us which is a better deal. We gotta do this twice. Sometimes it's gonna be one business that's looking to sell itself to 3 different people. So we value this business and then we say, okay, which offer looks best? Now, you might be thinking, well, that's going to be easy because it's just which is the highest offer. Not necessarily, because it's a mixture of how they're going to pay for the business. Are they going to pay all cash? Are they going to finance it? Is it going to be debt or equity? So we have to work out all those different aspects of it and like get the feeling for which one meets the needs of the client, right? So there's a lot of nuance, right, in this.
Just to give you kind of an example, if you look at last year's page, unfortunately, I don't have page numbers, but there's a page toward the beginning that says, please evaluate the following options. And so that's what we did last year. We had 3 options. We evaluated all 3, and then you make the recommendation which option is the best. So you can kind of look at that to give you an idea of an example of what we're trying to do.
Yeah. Thank you. Valuation, want you to think about it conceptually in this manner. What would you pay for a given income? And I said you get $1,000. Let's just say, we'll make it more simple, $1,000 a year for the next 10 years. And, well, that's $10,000, right? So what are you going to not pay more than? Well, obviously not more than 10,000, but you're going to pay 10,000. You're going to give $10,000 that you have command of right now, and then not get, and then just get it back piece by piece for the next 10 years. Tell me why that's a bad deal. You said
Investing or dying.
we could invest this 10,000 and get and have more than 10 over that time period, right? That's absolutely right. And I'm just kind of thinking about like, what's the flip side? I have it now, and if I have to wait, there's fewer things I could do with it, right? And there's uncertainty. Yeah, so you basically covered all of it. So we got to say at what 10,000 is not a good deal. Well, is 999 a good deal? Is 995 a good deal? Is 900 a good deal? Or sorry, 9,000. Is 9,999 a good deal? No. Is 9,500 a good deal? Maybe. Is 9,000 a good deal, right? So, okay, yes, now we need to do some time value calculations to see exactly what amount of money is going to make this a good deal. And what's going to be the key thing? Well, you said we can invest it, and you said time value. Okay, so what's the key ingredient in our time value equation? A rate of return or interest, right? It's a rate of interest. That's what we could get if we kept the money ourselves and invested it ourselves, right? Rather than swapping it for that income. So future value. How many know the future value equation? The simple one. I want to do future value first. We're not going to deal with future value, but the reason I want to do future value first is because present value is just the unwinding or the reversing of the future value equation, right? Present value times to the power. I'm going to say C for this cash. Okay. So the cash you have. Wait, I'm doing future. Sorry, I'm doing future value here. I'm going to say M. Let's say M. It's money. Okay. There's several different ways to write the equation. I'm not necessarily going to write it like your finance professors do, because I'm an economist first and foremost. So I just want to think more conceptually rather than kind of technically. But it's the amount of money you have multiplied by equals R. That's your growth factor, the interest rate, and then 100%, and then the rate of growth, right? Or to the P, or sometimes N, right? So to the number of time periods. Everybody familiar with that? Your basic growth the exponential growth function, right? Okay, so that's what money will grow to. And we can say the $10,000, we can plug that in here, and if we can invest it in treasury bonds, which, by the way, but you'll notice any of the major business, economics, finance websites, newspapers will have that right up there with all the stocks. So here's our 10-year yield, about 3.5. It was about 4. It's like maybe we peaked in this rate hiking cycle. Really interesting question. Actually, this is like economics finance. This is why I like money and banking. Like the main application of that in the business finance world is going to be what's the path of interest rates, and then what's the real rate and stuff like that. So when I think about what's the rate I could grow this money at, that's always going to be my starting point. I could put it in a safe, secure government bond portfolio and probably earn over a long period of time. We're talking about a 10-year thing here. That's 10-year maturity, right? The shorter ones are a little higher than that. Now we've got what's called an inverted yield curve. They're about 4. I can look at that in a little bit. We can look at the yield curve in here. But okay, so that we're going to start at, let's say the minimum we can get is 3.5. And then of course I won't get into the logic in this or the math in this, but we could go to other assets which could earn us more, right? And what's going to be true about an asset that could earn us more than the 10-year treasury? It's going to have to be no, it's going to be riskier. Why is it going to be riskier than the treasury?
You can't lose with the treasury.
You can't lose your nominal principal with the treasury. Why?
Because the government,
Like,
like the video says that they can just make more money.
Yeah, Alan Greenspan said it out loud in, I don't know, like 2008 or something, and I have that little video clip in a lot of my lectures. Alan Greenspan, the highly respected economist, former chairman of the Federal Reserve, said that the Federal Reserve will print money to pay the government's debt when and if needed. And they're effectively doing that. Of course, that's potentially inflationary, which we've seen. We've kind of put our toes in the waters of that, and that's kind of scary and nerve-wracking, but it's the situation. So that you will definitely get your money back. And anything else, now, most things that are issued by big, stable, secure businesses, you're going to have like a 99.9999% chance of getting your money back, but there's going to be a little bit of risk entering. And then for less stable, less secure, less established businesses, it might be like a 99.5 chance, right? And then it's for something even rockier, it might be a 98% chance. And then if you go with this crazy newfangled stuff, penny stocks. I was thinking like crypto exchanges, maybe. Then it's getting really dicey. It might be like a 70% chance. So stuff that promises you fantastic, unbelievable returns might be a fraud, right? No saying if it sounds too good to be true. Probably is. So you got to be really careful, but there is a risk return trade-off I'm familiar with. So we have to assess that. And that's actually a big part of this. That's this. That is, well, what is the return that we expect to earn? Well, there's an equity component and a debt component, so we have to average this together. So we come up with a discount rate, or this is the thing that I kind of hate about finance, but I kind of like too, because once you master this, then you can sound really smart, because there's like 8 terms for the same thing. You said rate of return. You said market rate. Well, actually, market rate and the rate of the discount rate are kind of different. But yeah, but for this term here, what could we call it? Discount rate. Yeah, the interest rate. Required rate of return. So there's lots of different terms. Different people use different terms, but that's it. That's the rate of return that we need to earn. So we'll plug that in, and then we'll run and say, okay, how much would that $10,000 be worth? Now, we are not looking at necessarily at what the $10,000 worth going forward. We're saying we know what we could get in the future. We want to take this backward and say, what would that be worth today at that rate, right? So if we're going forward, we're going to multiply by the growth factor. If we're coming backwards, that's the undoing of that procedure. So present value, which you probably know already, is what?
For cash flow?
Yeah, well, look, we're gonna do a lump sum here, and I'm not even gonna get into the cash flow formula because we'll just have Excel do it for us, right? I just want us to understand the concept.
Future value.
Yeah, and so this one's multiplying, see what it's gonna grow to. This one is saying, it has already grown to this, let's go backwards from that, or let's unwind. So we're gonna divide it, right? So that's all you need to know conceptually here. So it's amount of money, yeah, and it's technically the future money. This is money now that you're gonna invest and grow. This is money that you will be receiving. And what it's worth today is just divided by your growth factor to the time period. Yeah, so that's kind of all you need to know for, as far as I'm concerned. Now, your finance professors might have other requirements, but then that's fine. But that's just conceptually, right? I want to keep it simple. This is what you need to know. So when we say what would it be worth to pay for that, we're going to use a present value function. So we'll plug the numbers in. Now, the big deciding factor here is what is the rate we need, because as we'll see here momentarily, when we start doing the numbers in Excel, that's going to make a big honking difference, especially when the T factor is significant. If the T factor is not very significant, and what's the least significant the T factor can be? The number of periods. Actually, like for that, because Excel does this as in per. So maybe that fits a little bit more with how Excel does it. We want to kind of get our Excel brains on here. So what would the least significant value for that be?
Yeah.
Well, anything for the zero power just collapses to 1.
Yeah.
But you're on the right track. 1 is just 1 year. That's not going to really factor in. So if that goes to 1, then everything hangs on the rate, right? But if that starts getting bigger, now we're talking about an exponential function, and that starts compounding. What's the biggest factor then? The n will be the bigger factor. The rate will go away. Now, in reality, what are we going to be? We're never going to have like n go to infinity, but it's not going to be 1 either. We're probably going to be looking at, well, we're going to be looking at, I don't know, 10, 20, 30-year time spans. And if you have done much with present value, you know that the farther things go out in the future, regardless of the interest rate, as long as it's positive, they kind of fall out because the present value gets vanishingly small. So this will matter a lot then when we're looking at kind of what the median terms for the number of periods. And what are we going to see when R is higher? What happens to present value? Well, we're taking a given M, a given amount of money, and we're dividing it by a larger number. The result is smaller. When R is smaller, taking a given amount of money, dividing it by a smaller number. The result is larger. And what does that bring us to? That brings us to the Bocephus principle. Don't worry, we're not going to watch the whole thing.
The preacher man says it's the end of time, and the Mississippi River, she's a going dry. The interest is up and the stock market's down, and you're only getting mugged if you go downtown.
Did you catch that? No, I mean, yes, but that's not the important thing.
Interest is up for market.
Interest is up, the market's down, right? That's just discounting. Yeah, who knew? Hank Williams had a finance degree. Well, he doesn't, but that's just wisdom, right? Because when interest rates go up, you're discounting any asset that's going to earn us money in the future by a larger factor, right? Hey, have we seen that? Have you ever seen that happen?
What's it right now?
Well, the 10-year treasury said, well, what's that? You should know. I'm gonna start asking you that when I just see it. When I see you on campus, I'm gonna say, what's the 10-year treasury doing? What was the 10-year treasury 2 years ago? I think it got below 1 during COVID. So when the 10-year treasury collapsed, the stock market collapsed too because of business factors. But once the economy recovered and that interest rate was still low, what happened to the stock market? 2021 was one of the best years of recent memory. But then we also had this pesky little inflation and too much aggregate demand. And so the Fed had to raise rates, or maybe the Fed was forced to raise rates by the market. It's an existential question of monetary policy, but we don't need to worry about that. All we need to realize is that we saw that treasury rate go up a lot, right? Less than one. In fact, let's look at that 10-year. Let's look at 10-year over three years. Okay. Look how low it was. It was below one here for a long time. And then when COVID lockdowns were like what, spring of 20, right? Unemployment spiked, but then the economy recovered pretty quickly. And during like late 20 and then through 21, the economy is recovering. But look at these interest rates are still very low. The 10-year treasury is below 2 that entire time. So we've got low interest rates and growth and kind of normalization of the economy. Yeah, asset values are going to spike. And the asset values spike, we get a lot of inflation, the market or the Fed, whatever, is going to raise the rates and the rates go up. And then look at the jump in rates here through kind of the second half of 22. This is a big rise. We start 22 down around 2%. We end it at 4% roughly. Wow, that's a doubling of the interest rate. And yeah, no surprise, your factor went up quite a bit. Your present value is going to go down quite a bit, right? Now, is it a direct application when it comes to stocks? Like we can plug that, okay, we've got the future cash flows of that business. We've got the rate we need here. Therefore, we know what stock values are going to do. No, but kind of yes. If you're looking at like the big picture over long periods of time, yes. If you're looking at day to day, no, because what other factors are driving stocks? Yeah, psychology. Is it a meme stock that people are flooding into for stupid reasons? Gambling on basically, like what did Elon Musk say on Twitter or whatever, right? So there's all these little bits and pieces of information and data and speculation, right, that are driving day to day. But in the long run, this is what's driving. Okay. We're like thinking about the long run for a particular company. This is what's driving the valuation. The key things then are going to be what? How much money do we think they'll earn? Now, the nice thing about that is they give us that. Here's the financials. We don't have to make that guess. And if you run this math correctly and they say, well, how sure are you on those income projections? You say, we're not at all. You gave us the income projections. We're just modeling it based on what you said the income would be, right? So you have no, what do I want to say? You have no liability for this component, the money they earn. Now, of course, yes, we're going to do a present value summation series, right? Because the present value, the income they earn in year 5, 6, 7, 8, 9, 10. I don't need to show you that now. We basically run this equation again and it goes up by 1 each time, right? Right. Excel will handle the difficult part for us. Just want to think conceptually. So we're not responsible for this. We're not responsible for that because they're going to give us a definite kind of timeline, 5 years worth of projections, and then what we call a residual. Okay, and I'll show you how to work through that. So what are we responsible here? What are we, the consultants, responsible for? Right. Only the rate. But as I'm about to show you, that's going to make a potentially huge difference in the valuation. So you'll get it right. What is right? It's a metaphysical question because it depends. What did we say about the relationship between, or let's put it this way. Why would the rate be higher for this company versus the 10-year treasury? It's 3.5. You all said it earlier. I just want to rehash it because of the risk factors, right? So what are the risk factors? Well, that's the consultant's job, is to think through the risk factors, right? And then accurately assess them. And then the financial consultant's job is to package the risk analysis down into a number that we can use for valuing the asset. Okay, the WACC, weighted average cost of capital, is going to be the risk adjusted, so to speak, rate of return that we use for this valuation procedure, right? Everybody with me? Okay, so that's how you do valuation. Conceptually, are you going to look me in the eyes and say, I don't understand that, Dr. Watts? Are you going to say, yeah, okay, conceptually, I see all those bits and pieces that go into it. What's the hard part about it? It's the math, it's the analysis. Good news is Excel will do all the math for you. On the analysis part, well, you got a team of 4 and you put your heads together We'll have some synergy there. And then you have us, the faculty advisors, to consult. So you'll get it. The only challenge is, can you stand and deliver then, right? Can you act like you think you believe in what you said? And it's like, yeah, act like it's good. And then they'll probably believe you, right?
Actually, be
It's all about
confident.
It's all about confidence, it's all about bluster. So, okay, let's do some actual number crunching. Okay, so let's start with just a really simple one. This is like a finance textbook type problem that I thought it was kind of useful to think about. I know these numbers are way off, but this will be kind of a little warm up. Suppose a Steph Curry, basketball player for the Golden State Warriors. Yeah, we know who Steph Curry is. Will become a free agent at the end of the season. Suppose that Curry is considering 2 possible contracts from different teams. Note that the salaries are paid at the end of each year. The interest rate is 10%. Curry is indifferent between the 2 teams and only looking to maximize his income and wealth. Which contract should he take? So interestingly, the naive person would say, well, that's a $10 million, that's 10 million, that's 10 million. I can prove that for you really easily by running a sum function and then filling it. Okay, it's $14 million in both cases. It's the same, right? How is it not the same? Tell me why it's not the same.
You get more money in the first year with the first contract.
Significant amount of additional first year money, more first year money with Boston and Portland, right?
Mhm.
So why does that matter?
Because then the interest start like growing.
Okay, you want to think like a finance guy here, and that's great. I like that. Somebody tell me, maybe without reference to interest.
You get more money on here.
Okay, I'll go with that. I'll go with that. So you see how there's like multiple lenses you could think about that. This money, I have more money earlier to invest and earn on. Yeah. We could also say, I have that money sooner. It's better to have it sooner than later, right? This is called, and that is the origin of interest rates. In fact, which we call it originary interest. It's based on time preference, but we can then prove that mathematically. Now, if we're doing a string of annual a sequence of annual income payments, we can just run the net present value NPV. Okay, now, whenever I do this in Excel, notice Excel will bring this little box up that tells you what arguments you need in the function. Okay, so what do we need in this function? We need a rate. I said it's 10%. I don't have that in a cell, so we'll just type it in. Okay, then we just need the series of values. And I think that's all actually. Okay, so that one has a net present value, which means the sum of the present values of each of those payments added up. So this one, and it's not a huge difference, but $300,000. Maybe Steph Curry doesn't care about that, but if you're his agent, do you care about that? Yeah. And as long as he's indifferent between Boston and Portland, then it's an easy decision, right? By the way, what did Excel just do? It took the present value of the first year salary discounted by 1 year, present value of the second year salary discounted at 10% for 2 years, present value of the third year salary discounted at 10% for 3 years. And then it added those present values to the $1 million, which is right now. So it already is in the present, so we don't need to take the present value of it and then just added them up. Isn't it nice that Excel can do that for you like that? Yeah. Actually, I meant to do this one first, but it wasn't first in my sheet, but that's okay. Bond value. Now, how many of you have done a bond valuation? Bond valuation is it's really fun because once you get good at it in Excel, you can just fly through it and you can impress your finance professor. Okay. Find the current value. Now, and what's a bond? A bond is just structured debt, right? Coupon the principal is usually 1,000 or 10,000. Coupons are paid semi-annually, then they trade. So the pricing, you can get the valuation really easy. If you're a bond trader, it's all math and it's really easy. So let's just run a couple of these. And I want to show you just the impact of interest rate changes. So find the current value of 5-year 5% coupon bond. So I notice when I do evaluations in Excel, I always structure them I always want to just make a table of my arguments, structure it in the order that the Excel functions on. Rate in for payment PDF. Now here, of course, we're calculating PV, so that doesn't come in the arguments. That's the function we're running, right? So it's always this rate in for payment PVFE type. You can do it differently if you like. For me, that helps me remember how Excel is going to crunch that. So what goes into rate? Let's skip that. What goes into inper? Number of periods. 5, right? It says 5-year. What goes in the payment? Okay, 5% coupon. That means it pays 5% of par to you in interest every year. So that's 5% of 1,000. 50, right? So it's going to earn us $50 a year. Whoops. Goes in the FB. 1,000. That's the principal. You always get the principal back at the end. What goes in the type? Doesn't really matter. I usually go with 0. It's not going to matter. I'll show you if we change. That's at the beginning or end of the period assumption. It'll change it a little bit here, but usually doesn't matter. Okay, so the big question is rate. And what is rate here? Rate is the thing. Remember, I said that's the thing we're liable for. That's the thing we have to decide when we're running the PV. So what is that? You got 2 choices here, right? If it is semi-annual, then it pays half of the interest in June and half in December or whatever, January. So you divide the rate by 2, and so it would be $25 here and $25 there. But we can, like I said, we can set that aside. What's the rate that we're going to value it at? 3%, right? Why not 5%? It's paying 5%. Yeah, it's paying 5%. We've got that. That's captured in the coupon. We are valuing this at 3%. Well, why would we be valuing this at 3%? Where do you think the 3% thing came from? It said the current interest rate on similar assets is 3%. Remember, and what I said, what's always going to be our baseline for comparing the rate? 10-year treasury. Okay, this is maybe, if this is AAA, it's got to be pretty darn close, maybe just a little bit higher than the 10-year treasury. Okay. If this is CCC, it's got to be a lot higher than 10-year treasury, right? But we'll say similar assets is 3%. So that's what we put in there. Then we just run a PV. And you see how it's easy when you set it up this way. It's that, and then that, and then that, and then that. And then, what is that? C12. Bada boop. Okay, now it's showing it as a negative.
You just have to put a negative in all of these.
Yeah, we can solve that by making the. Now we got to make both of these negative. The reason why Excel puts that as a negative is because Excel wants to think about, okay, well, these are payouts from the bond. So if we make those negative or outflow, then that's the value. It doesn't really matter. Of course, you don't want to present negative valuations. So you can do what I just did, or you can also just do this. You can either just multiply it by -1, or you can do an absolute value function. Okay, so let's set it up like that. Okay, now we're going to run the exact same thing again, but we're going to say the threshold rate, the hurdle rate, interest rate, whatever the discount rate is 4%. Watch how easy it is to run a new scenario. Let's change up to 4. Interest went up. Let's see, if you ever forget, just remember, go see this. Interest is up and this down. It works. That's how I learned finance. Okay, I'm serious. I knew Hank Williams song before I knew finance. Okay, but I harkened back to it. So when the interest rate went up, the present value went down. Did it go down a lot? Well, $50. I mean, yeah, that's like almost 5%. That's kind of big. By the way, and by how much did the interest rate go up? Well, did it go up 1%? Ah, excellent. What's your name again?
Lilia.
You are a finance person. Yeah. Talking about basis points. It went up 100 basis points, which was 1 percentage point, right? It went up 1 percentage point. In percent terms, how much did it go up? It went from 3 to 4. The difference, the delta is 1, the base is 3. It went up 30. Yeah, it is 133% of its former value. It went up 33%. That's a pretty big jump in interest rate. That's a 33% increase, or 100 basis point increase, or a 1 percentage point increase. Now, which of those is the way the finance and business and valuation people are going to talk about it? Basis points. So, right, if you don't know what that means, write it down and start using it. Let's make the interest rate go down. Oops. Copy and paste. It's the beauty of Excel. I only had to do real work once, and the rest of my life I just copied and pasted what I did last time. Okay, and it went, this time the interest rate went down, so put Bocephus in the reverse, the present value went up, right? And then, yeah, about $50 again. Everybody with me so far. We are getting very close to doing something, close to what the ACG cup thing is actually. So what I got here is some little bit more realistic type of scenarios. A rental property. Oh, this is fun because I know this guy who's a big rental property investor. Dr. Cartwright. Anybody know Dr. Cartwright? He's really smart about it. And yeah, he does this kind of math a lot. He also is really knowledgeable about the markets he invests in. What would it rent for? How much is it going to cost to rehab it? And all those other little factors. So you can make a lot of money in real estate and rentals if you know the business. It's like, I see all these seminars and infomercials and stuff where, oh, make easy money in rentals. It's not easy. Nothing is easy. You have to know the business. If you know the business, you can do well. And you have to know the business, you have to know the market, and you have to know the finance part. All right, so we'll do a kind of really simple, simplistic version of the valuation here. A rental property is expected to earn $9,600 yearly net income. You expect the unit to last another 20 years before needing total replacement. Now, that might sound crazy. Like, well, the building's not going to collapse in 20 years. Well, I've seen buildings that will collapse, maybe not in 20 years, but that's a safe assumption. And basically what we're saying is we're going to need to spend major money to rehab it and remodel it in 20 years. We could relax that assumption. I'll show you it's not going to have that big of an impact. The big thing is going to be, okay, how much money does it earn us? That's the cash flow. Your opportunity cost of capital. Oh, wait, what am I saying there? That's how economists talk about the required rate. You said required rate, right? Required rate is maybe a good term conceptually, because what does that imply? I have to earn this much to make this investment worthwhile. If I don't earn that much, because it's like, well, if it doesn't earn at least 3.5%, where could I go with my money? 10-year treasuries, right? If it doesn't earn at least 7%, if this is a long-term investment, where can I go with my money? Which market? The stock market, exactly. Yeah, and I'm specifically talking about the S&P 500, which we can go back and look for 150 years worth of data. Let's go to Money Chimp. Like, don't laugh at the name. They've got some really useful data here. It's the one I want. Stock market, CAGR later. Oh, by the way, that's another term you should know. CAGR. It's not, don't get excited. It's not a frat party. But they do, sometimes they call that a CAGR. Anybody recognize that? Compound annual growth rate. Stock market earns about a real rate of return. Now, somebody who's talking about inflation. We left. That's a really good thing to bring up, because there's been a lot of inflation over this. So we're going back for 150 years. Can you guys see that? Okay, let me just try to zoom in here. Okay, so this has I think it's basically, yeah, the S&P 500 for the past 150 years. If you reinvest dividends, the average return is about 11%, 10.8%. Annualized. Now, why is there a difference between the average return and the CAGR, the compound annual growth rate? The average return just says, okay, the overall that thing grew by whatever, like 300% or whatever it is, and then divide it by 150. But it's really a smaller rate than that. Why? Because you reinvest the earnings every year and you get growth on the growth, you get compound, right? So the CAGR says what growth rate in a future value function would get us from wherever we started to wherever we ended. And then if we modeled that, what would it look like? It would just look like the smooth exponential growth curve. Now, is that what actually happened in the stock market over the last 150 years?
No.
No, what actually happened is it does this, and then there's a Great Depression and does this, and it's fine, and it peaks in 1966, and it sucked for the next like 20 years, and it did great in the 80s and 90s, and then it crashed in the 2001 bubble, right? .com crash. So it's massively volatile, but it does have that strong upward trend. So some economists will kind of bicker about, well, you got to be aware of the fact that the actual growth patterns don't quite model this, but say it's good enough. And if you want to be conservative, just knock off 50 basis points, or if you want to be really conservative, knock off 100 basis points. Knock off 100 basis points of that, you're still earning 8%. Are you happy with that? If you're not happy with 8% long run growth, it's like, I don't know what to tell you. Get out of here. Go to the casino, I guess. Try luck. But anyway, what about inflation though? Let's adjust for inflation, because what's happening to the value of that money you earn? It's going down at, anybody have a guess at what kind of inflation rate we've experienced over the past 150 years? Probably something like 3%. Actually, that's almost exclusively over the past 80 years, actually, because up until the Great Depression, we were on a gold standard, which anchored the long run value of money pretty steadily. And then we kind of gradually abandoned that after World War II. But anyway, yeah, 3% is probably about right. Let's see. Basically, you can simplify that math by subtracting it. Let's see what we get to. We get down to 8.5%. So that suggests that inflation, what was it, 10.81? And what is it now? 8.57. Okay, 2.24. But remember, that's going back into the gold standard years when prices were really, in fact, there was times in the gold standard days when prices gradually went down over a long period of time. So maybe that inflation rate is probably like 3.5 in our era. But anyway, you see that, okay, annualized rate of return, true CAGR is 6.91. Let's round that up to 7. That is my opportunity cost of capital. What else could I do with my money? Invested in stocks, maybe, right, and invested in a broad market portfolio of the entire economy. Don't be gambling with penny stocks and trash like that, right? Just park it in an index fund, pay no fees, and sit back and relax, and don't watch the stock market every day. Or if you ever wonder, where do you get these numbers, Watts? That's where I get it. I got to earn, I rounded it up to 7%, right? My opportunity cost of capital is the expected 7% real return on a broad market equity portfolio. Oh, and by the way, that would be a little bit higher if you did in an international portfolio as well, but let's just use that as our baseline. Okay, so let's fill in the stuff. I got rate, in per, payment, FB, PB's what we calculate. So what's my rate here? What's my opportunity cost of capital, or my threshold rate, or my required rate, or whatever we want to call it. In per, I specified that for 20 years. Payment, that's my cash flow. Future value, look, I'm just going to say 0. You're saying that's unrealistic. That thing's not going to become completely useless. It's not like somebody's going to burn it down. And even if somebody burned it down, isn't the lot still worth something? Yeah, but just like I said, it doesn't matter that much. The main action here is in the rate, period, and the cash flow. So now we're just going to run a PV. Whoops. And remember, I always structure these so I can just click my way through. And by the way, you can leave the, notice when Excel brings the helper box up, it puts some things in brackets. That means you don't have to enter them and it'll make an assumption. So like if you don't put something in for type, it'll assume 0. If you don't put something in for add B, I think it will also assume 0.
I have a quick question.
Yeah.
Just because I'm forgetting, type, which one is 0 is?
0 is end, 1 is beginning. I'm 98% sure. You guys know what the problem is? This is not even an error.
It's too
Too big. So I'm just gonna make that wider. There we go. Oh, it's -2. Yeah, let's just multiply by -1. Okay, so that my model says that's what if I paid $101,700 for that today, and then got that $9,600 in net income every year, cash flow, I would be earning 7% on my 101,000, okay? So what does that tell me as an investor? I say, okay, I'll pay up to 101,000, but if I want a real deal on that thing, I gotta earn maybe more than 7 because I could earn 7 in the stocks. What do I need to earn on this thing? Yeah, like I want a real deal here. If you go out, ask Dr. Cartwright, he will look at 100 properties, bid on 10, buy 1. Why? Because he wants a real deal. There's a lot of potential deals out there. Give me just one really good one. I don't have the time or energy to even manage 10 deals. So just give me like 1 or 2 really good ones a year. So I'm gonna go big. I'm gonna pay $50,000 for that property. And maybe we'll spend like $15,000 rehabbing it, and then maybe 1 or, you know, we can change all those other assumptions and find it out. But right, when the interest is up, the present value's down, the value's down, right? That's the Josephus principle. You can see it in a big way there because we did a huge increase in the rate. Maybe we're a little more, maybe it's a pretty nice property and we're really sure about this assumption, so we'd be happy with 12, and we say, okay, we'd pay 72K for it, right? Remember what my initial question was, what should you pay for a given income stream? That's how we answer the question. And once we know what the income stream is and what the opportunity cost of capital is, notice when I say opportunity cost of capital, I hope that gives you a more kind of intuitive or conceptual idea of what that number, what that interest rate number means, right? What else could I do with my money? If you take my econ class, I'll tell you econ is only about 2 things, right? Write this down, then you don't need to take econ. You know, you should take econ, but no, seriously, write this down. You basically got it, and the rest is just practice. Econ is about 2 things. Opportunity costs and incentives. Sometimes the opportunity costs are abstract, but sometimes we can figure, put in investing, you know, we can put a number there and we can do the math. The incentives part, that's really tricky. That's where you need like management philosophies. So how do we get people to work, right? Rewards and penalties that influence behavior. But anyway, that's the econ. So this is an economic way of thinking about the interest rate. What else could I earn? I got to earn that or higher. And therefore, okay, what does this mean? If I put 71,000 in and it earned that for that long, that means I'm getting that rate of return. That's a nice, attractive, acceptable rate of return. I'll take it. Deal. So what are we going to do in ACG Cup? We're basically going to say, we've got, instead of a rental property, or instead of a bond, we've got a company. But what good is a company for you, the investor? Cash flows. Every year, it cranks out money that you can use to buy cool stuff, right? Private jets and yachts and stuff like that. So, or if you want to be austere, you can reinvest it and become even richer, right? What's that? Well, it's like, then we get into like the moral questions, but okay, we're just the consultants, right? And our job is to maximize value or maximize profits for our clients. So we're going to do this procedure on a company. And the way we're going to think about a company that's a little bit different, but it's not really different, is we're going to have their income statement. Okay, this is the rental property. This is just the income statement. It's really simplistic. Here's how much it earns me per month. There's the yearly gross. That's that times 12, right? And then here's expenses. Now, like I said, this is simplistic. If I was really running this property, I might have a couple more lines and try to get more details. But what are the main expenses when you own a rental property? Yeah, I know what taxes are. I should probably put that in. That's going to be a big one. Well, actually, no, that's actually in here. That's probably actually in here because my mortgage escrows the taxes and insurance. Utility.
Usually the renter.
Renter pays that. It's my biggest expense. What's my biggest risk if I own a rental? That people leave and stop paying, and then they have to find somebody new, and then January goes by, February goes by, no income. So I got to account for that. 5% is probably kind of low, but I just had to make these numbers work for my other scenario. And then the furnace breaks, the window breaks. We need a new roof, right? You got to put money aside over time to match the estimated accrual of maintenance. So we usually do something like that too. And so, okay, that's my expectation for my annual income or my cash flow, right, from this property, right? So if you were wondering where I get that number, that's where I got that number. So that's the income statement. Now, in a corporation, it's going to be quite a bit more complicated. Is it a manufacturing or even like retail? We're going to have top line revenue. We'll see this in a couple. We'll get there in a couple minutes. I don't even. Where's the dang scenario, Watts? I'm getting there. I'm building us up to it, right? We'll have like cost of goods, and we'll have payrolls, and yeah, we'll have taxes, and we'll have debt service, and we'll have amortization. Bam, 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 right? So just be more complicated, but it's the same concept. What we want to get to is the income. Now, for my little simple rental business, the income is the cash flow. That's nice, isn't it? For an actual corporation that's got a complex like asset and capital structure, they're going to have a lot of non-cash expenses, aren't they? Such as depreciation, amortization. We're going to have a tax situation to think about. And so what we're going to have to do is build a separate cash flow statement off of the income statement. That's where the accounting comes in. How many have had accounting yet? So anyway, my point is that there's a lot of work there, and it's kind of tedious number crunching work, but we got to get it right. Okay, but let me go back to my simple example. So that's our cash flow. Now here's what the ACG scenario is going to look like. We have a record of that income. For mine, it's easy. It earns $9,600 per year. So we've got a record of that income up to now, and we've got a projection of that income going forward. Now you might be thinking, well, watch that. Won't that rent go up every year? Because either because of inflation or because there's increase in demand, you're in a booming market. Yeah, possibly. We could easily factor that in. Maybe we will here in a minute. But I want to show you how we're going to structure this differently, but we're doing the exact same thing, right? We're doing the exact same thing. The reason we want to structure it like this, though, is because we will need some assumptions about income's going to grow at a certain amount, but expenses will also grow at a certain amount. And so I need to be able to kind of chart out the path that I think the income and expenses will take over time. So notice, okay, and we'll say this is our actual data up till now. Then going forward, it will be projections. What do we think is going to happen to income / cash flow? What do we think is going to happen to expenses? Well, actually, we'll have an entire projection of the income statement that's structured like this. Because my income statement, everything's fixed and really simple. I didn't do that here, but I'll show when we get over to the ACG example, you'll see how it kind of reflects that. And then, okay, so let's just stick with my rental property. What are we going to do? Well, I've got my discount rate plugged in here. I've got my cash flow, right? This is what the project, let's start calling it a business, right? The rental property is a business, right? It's just kind of a simple and kind of contained business, but that's a business. So this is the business. Here's the cash flows, right? Here's the rate we're going to value them at, and then here's the math. So we're going to, of course, use Excel, but you'll see they're pretty much identical. There's maybe a couple dollars difference. Oh, I did something. Oh, I know what I did wrong. Okay. Yeah, this is actually kind of, I'm embarrassed because this is kind of a rookie mistake. The 9,600 here, is it a payment? No. Why? You know, you caught it too, Adam?
Yeah, I have my beautiful little finance.
Okay. Tell us what I did wrong.
So if you set up the 96,000 of payment instead of future value, then when you do the next one over, it's counting 2 payments of 96,000.
Right. This is a future value, the way we've got it structured. It's not a payment because the payment occurs the payment occurs each period. So we doubled the payment. I've got to run this as a future value. When I went back on my original one, it's, oh, of course, I need to run that as a future value, not as a payment. So let's just redo this whole thing. Lesson learned. Rate is that, of course, and that'll slide across. Inper is that, and that'll slide across. Payment is 0. We're not doing this as a payment. We're doing this as a sequence of future values. Okay, so that means the future value is that, and the type is 0. That'll work. And then, of course, I'll need to plug a negatives in there. Okay. Yeah, and notice those are gonna stay within a few dollars of each other, so that's gonna be fine. And then what we wanna do is add them up. So I'm gonna sum this. And then I'm going to sum this now. I'm just showing you using the table numbers as by way of comparison. Look, they're within pennies, okay? So we can ignore the table, numbers. Just even delete those because it doesn't matter. We got what we need from the present value. Okay, 101, 702, 54. 101, 702, 54. Same thing, right? Same thing. This in here is actually a payment. See the difference between the payment? I only have to run the one function, whereas over here where I ran it, as a independent sequence of yearly projections, I had to run it a future value every time, and then I had to take the additional step of adding those up. Everybody, we're in the ACG valuation model territory now, right? So notice the differences, notice these little complexities. Okay, and speaking of that, so that's that. We could change the enterprise cash flow. We could just type in, we think it's going to be 10,000 in the next year and 11,000 or whatever, or we could set up a formula that basically just says, let me show you this really quick. We could just basically say, I think it's going to grow at 3%. And so the next year is going to be the previous year times 1 plus the growth rate, where we need to lock that in because it's always going to be that. And then we could just carry that across. Now, what's this going to do to the present value? It's going to increase it quite a bit, 20,000, right? So if that income grows every year, it's going to grow. Now, that of course, we'd have to go back here and say, well, the rent's going to grow, but the expenses might grow too, right? So we need to factor those things out independently. And in order to do that, we would need the income statement structured like this, where we have the full income statement for every year. Well, enter. Okay, here we go. All right, so this is what your actual case study will look like. Now, I don't want to take the time to go through the details of the case. You've kind of maybe read about it and see what it's about. Let's get down to just kind of the nitty gritty of the process. So this is the income statement. Now, yes, you will have to take it from the packet to Excel. I can help you with that. You don't have to type in every value. Not the Excel has some tools that actually makes it pretty easy to copy paste, but it might be a couple step process, but I will definitely help you with that if needed. You're nodding your head like you know how to do it.
Oh, no, I had to do this all by hand.
Oh, yeah.
I got really good with the number pad.
You can take the tedium out of that, but we'll talk about that later.
Oh, yeah, that was my job. That was all I did, was number entry.
Okay, so remember what I said about the money part, the income part, the cash flow part? That's, well, the income statement is given. Okay, that's just solid data. We've got, so this was 22's case. So we had the actual data through 21 and then projected for 5 more. Okay. We've got revenue, we've got COGS, there's our gross. We're just going to calculate the margin at every step of it. We've got our OPEX, we've got our depreciation, there's our operating income. EBIT, you know what that means?
Earnings before interest and tax.
Earnings before interest and taxes. Good. All right, so then here's our interest, there's our taxes. They call it net income available to common shareholders. That's basically our profit. Okay, that would be our net income or our profit. And then we're going to add back taxes, interest, depreciation, amortization to get our EBITDA. You can probably figure out what EBITDA is.
Just add the down.
Difference in the receipt? No.
Close.
Depreciation.
So it's earnings before interest, taxes, depreciation, amortization. EBITDA, that's the key here. And maybe Professor Azu can expound on why that is the key metric when we do the valuation. This is the number, when we do the multiple method, this is the number, and this is the number we want to derive the cash flow from as well. So on the next sheet, I'll show you we'll take the EBITDA, then work to the cash flow.
Well, one of my accounting students talked to me about what is depreciation and amortization. It's an expense on the income statement, but what is it really doing? What's that?
Of the assets.
Yeah.
Not really reducing the value, it's more allocating the cost. Right, it's allocating the cost of this period of time. But it's not really a cash expense, right? It's just allocating the cost of a plant asset or an intangible asset over time. So
The journal,
what's that?
a really good journal entries where you have like machinery, you have to allocate it to what you produce, like you balance.
Yeah, so like the units of production method of depreciation or something like that. So EBITDA is a better measure of. What's the word I want? It's a better measure of income for investment purposes. Because depreciation and amortization, I don't know what you're wanting me to.
No,
get
that's
at, but yeah,
exactly what I was- yeah.
okay,
So EBITDA is the kind of the magic number. That's-
yeah,
But we still need actual cash flow. So we're gonna go from EBITDA to cash flow in the next sheet. By the way, a lot of sheets on here. You want them all on one workbook because you want to be able to use cross sheet references. So you'll see a lot of cross sheet references. If you haven't done that before, you will. You'll do it now. You'll like it. Okay, so to build the cash flow statement, I'm just going to pull the EBITDA from the previous statement and notice. You guys know what I'm talking about when I say a cross sheet reference?
yeah.
A cell reference that's in a different sheet. The easiest way to do that is just to click in here. So how do you set that up? Well, I'll take it away and show you. It's easy. Let's just delete that. What I'm going to do is equals, and then I go to the other sheet and just tag that cell, hit enter. It'll take me back to the sheet I was actually working in. Okay, so that is all the EBITDA from our income statement. You do this math, you add and subtract appropriately, then we've got the actual cash flow number. Okay, now we've got the M part of our PV equation, right? All we need to do is run that 10 times. We've got 5 that are actual history, 5 that are projected, and they'll give us some assumption. They'll give us some projections, right? So we don't have to analyze or assess that. We've got the numbers. We're going to pull these enterprise cash flow numbers over to our, look at this, DCF, finally getting somewhere real. Let me zoom in as much as I can here. Okay, so enterprise cash flow, these are the actuals, right? But we're looking at the projections because when we are doing a present value, that's by definition looking forward, right? So it's not the 10 million that I calculated for 2017 there. 10.7 million. No, it's the 22 through 26 projection. So it's starting at the 14.5, the 19.9, et cetera. So that's where you see these numbers came from. These are cross sheet references drawn over. Okay. So we populate the top line of our cash flow statement is those projected cash flow numbers for the 5-year forward looking period. Now, after that, we have is this business going to come to an end after the 5-year forward looking period? Possibly, but probably not. So what do we do for all the years worth of income going forward? Well, we do what's called a residual. And usually the residual would just be, well, let's just carry the last one forward. And that's probably as best as we can do because who knows what's going to happen after 5 years. This business could take off and that could be double, triple. This business could become really weak and that falls by half. So who knows, right? There's just too many variables looking that far forward. So just carry the last number. And now we got 6 numbers to work with in terms of bringing it all back to present value. Okay, so what do we need to do with present value function? We've got the M part. We've got the N, it's just given by however many years out we are, right? So all we need is the rate. That is called a WACC assumption. We might have to talk about where that comes from later, because I have to do a whole separate spiel on the CAPM model. We'll say, I'll keep going if you guys have time, but we can talk about it later. But anyway, for now, we'll just say, okay, we came up with that through some analytical process, right? So that's the rate we're going to use here, 11.3, right? What, just kind of evaluate that rate. Higher than what? Higher than that, where we're always referencing that risk-free rate of return, the treasury bond, the 10-year yield, right? Of course it's higher. How much higher? Now, remember, this was a year ago. Treasury bond yields were probably at least 100 basis, probably 200 basis points lower. Let's say the treasury bond yield was 2% at this point, 200 basis points. So how much higher? The treasury bond was 2%. Our WACC here was 11.3. How much higher? 900 points, 5 times, right? It's a lot higher. Why? Because this is a business with a lot of risk. Okay, good. You guys are catching on. And if we think there's more risk here, that goes up. If we think there's less risk here, that goes down, right? That's probably good enough for now. We'll get into the nuts and bolts of fine tuning that number later on. Okay. Oh, forgot to mention this before. Discount period. 2022. We were doing this work like on January 1, let's say 2022. Well, that income, when do we actually get 2022's income? Do we get it all on December 31st, 2022? No, when do we get it?
At some point.
Every week through that year, right? Or maybe it depends on the kind of business, sometimes every day, right? If you're running a convenience store, you get income every day. You probably make a deposit every day. So is it realistic to say, to use the model that says all that income is going to occur 1 year into the future and we're going to discount it back to today? No, that income occurs potentially every day through that year. So it's unrealistic to say it all occurs paying one shot at the end of the year. So instead of putting a 1 there, we're going to kind of compromise and do what? Put a 0.5, which means what? We're kind of like, well, let's just say all the income for 2022 happens on July 1st. I mean, of course, that's unrealistic, but it's more realistic than saying it all happens on December 31st, right? Does that make sense? So this is called the half-year assumption. And that's why we're going to run the PVs with 0.5, 1.5, 2.5 instead of 1, 2, 3. Okay, that's the half-year assumption. That's kind of important. Now, you don't have to think about that anymore other than knowing why. Maybe you'll get a question about that, probably not, but just be prepared. I'd hate for you to go up there and say, why is your discount period in 0.5 intervals? And you would just like, right? So now you know. Well, that would be a good answer if you didn't have any other answer. Honestly, if you didn't know why, I was told, my professor told me, that would be better than just babbling, right? That would be better than claiming you need to go to the bathroom and then like running out of the building. Yeah, okay. So then we're just going to run the PV math, bada boom. And yeah, I did it right here. It's not a payment, it's a FG, right? So we run the PV math, fill it across, it's easy. So we got our PV for every year's cash flow. Whoops. And then what? Well, we just add them up, right? But there's a little bit of a quirk. Man, we could have been done. It could have been, I don't want to say simple, but less complicated, but we have to add more complications here. So I've got the sum of the 5 concrete projections. So the 5 actual projections we have through 26. What do we do with the residual? Well, notice that I'm PVing the residual itself. Why am I doing that? Because the residual occurs basically year 6, right? So what I'm going to do here is take the present value of it at 5.5 years. Okay, that's what I did there. Okay, so this is the present value of the residual. Okay, so keep that in mind because we're still not done with it. Okay, there's 2 ways to deal with the residual then. We want to say, I'm going to try to make this really simple so we can wrap up in a few minutes. This says the residual will probably just keep in other words, the amount of income we earn going forward beyond our projection window will probably just steadily rise by a certain percentage every year going forward. And basically, we're going to treat it as, if you have income that occurs forever, that's called a perpetuity. You guys are familiar with that at all from your finance classes? I don't know if British Consul still exists, but the Consul was a perpetuity issued by the British Treasury. And it's really easy to value perpetuity, right? Just divide it by the cap rate, there's another term, cap rate, discount rate, the interest rate, whatever, threshold rate. So divided by the capitalization rate. Now, notice that the capitalization rate here is less than the WACC, the interest rate assumption for my PV. The reason for that, and basically the math for the cap rate, I put a box in here, the discount rate basically minus the expected long-term growth rate of the income, right? So we're factoring in the growth by making the discount rate smaller. How does that factor in the growth? Well, remember, when the interest is up, the stock market's down. When the interest is down, the value goes up. So if we shaved off the points of the growth rate off of the cap rate, that gives us a bigger result that puts into that term the growth we expect it to have. Does that make sense? Starting to get the feeling the confused looks because there's so much data here, I know. But we can discuss that in depth later if we need to. Okay, so I will use that assumption to get the present value of the residual income that's from year 6 through forever. And we take the present value of that, and it's, the perpetuity method. I'm dividing the income by the rate, 267 mil. But maybe, I don't know, maybe that's not safe. So let's do something else. Okay, residual with this, the exit multiple method. Here's a residual period EBITDA. So we're back to the 23. Now, notice we haven't taken the present value. We're back to the 23. Multiply by the EBITDA multiple. What is that and where did it come from? We'll talk about that momentarily. And, well, actually, I should talk about it now. So this is the EBITDA, this is the cash flow, well, not the cash flow, this is the EBITDA the company's going to earn in that 6th year going forward. And the other valuation method says, you're just going to pay some multiple of what the firm cranks out in EBITDA every year. Where does that come from? It comes from looking at other businesses that we think are comparable and saying, what did they sell for? This is how you would appraise the antique diamond necklace. Well, we saw this one sold at Sotheby's last year for $10,000. This one has a little bit more gold, so it's probably worth $12,000, right? So that's basically what we're doing there. I'll cover that if we have time. So we're just going to do that math, that times that, 235 mil. And then we say, okay, in reality, the residual income is probably worth something in the middle of the two methods. So we're just average those two numbers up, bam. So this is what we think our residual is worth. Now, what do I still have to do with my residual? Because it's occurring in years 6 through forever. I still have to present value it back to right now. So that's what I do here with my averaged out kind of guesstimate of what the residual income will be. Okay, so what's the company worth then? It's worth the present value of the projected cash flows for the 5-year window, plus the guesstimated value of the residual cash flows. So it's this adds up, and bam, this company is worth 233 million. Done. Slide that number on a piece of paper. We're done, right?
Which one?
Are we done? No, you're gonna just give me one method. You're just gonna give me the finance nerd method. They might not even know what we just did. Now, a lot of them will, some of them won't. A lot of people though want a maybe more simple and maybe more intuitive way of doing it. Somewhere in this packet, I think it'll be towards the end, they will give you a lot of data. Okay, so these are basically, here's other businesses, maybe across the country, across the world, possibly that sold recently. Here's what their revenue, EBITDA was. Here's what they sold for. That's enterprise value. Okay, enterprise value is what it was valued at when it was sold / purchased. What we want to say is, okay, basically, how much. What multiple of earnings did these investors pay for this business? And it's kind of like, you can think about the bond value question is kind of the same thing, although we don't think about it as a multiple of earnings. we think about it kind of as the inverse of that, which is, okay, what did we pay for this bond? Let me make the math simpler on here. Let's just say that the rate is still 5 and the bond pays 5. So when we do the math, it's going to be worth exactly $1,000. Okay. Now you can think about that. All right. That bond, that $1,000 investment earns me how much every year? 5%, $50, right? But you can also think about it this way. I'm getting $50 a year for however many years. What am I paying? And then the $1,000 back, right? So just forget about the $1,000 back. Just kind of, you assume that that goes on forever, but you could just reinvest the 1,000, right? So how much is that worth? Well, it's worth, how much bigger is 1,050? 20 times, right? So we would just say that is a 20 times multiple. Does that make sense? A 5% income on a given principal, 5%, let's call it a rate of return to use finance jargon, or a 20 times multiple of income, or we might say earnings. Follow me? That's the same thing, right? It's the same thing. So far we've been talking about the rate we need to earn on the investment. Now we're just flipping things around and saying, here's the multiple that it sold for. This business earned 2 million of EBITDA and it sold for 15.6 million. Just divide the value by the EBITDA it sold for, 7.4 times its income. This one sold for 8.388. And notice there's not going to be a wild range here. Some businesses will trade for a pretty low multiple. Why do you think they were only willing to pay 5 times the earnings for this business, but these guys were willing to pay 9.8 times for that business? What's the difference in those businesses? Oh, these investors were duped by slick sales presentation, and these investors were really cautious. Maybe. Maybe this business looks a lot tastier than this business, right? Possibly as well, right? There's a whole lot of factors that could go into that. We assume that the investors are all really diligent and the numbers are all really safe and strong, then the only difference would be what the expected future growth / the risk, right? So high multiple means what then? I'm willing to pay a lot for this business.
Higher return.
It looks like a sure bet, right? So what would we say in terms of risk? There's less risk. A high multiple, 20, we're looking at multiples of like 5 to 10. So a 20 multiple looks really big, right? A big multiple corresponds with a. Is that a big rate of return? That's a small rate of return, right? What's my, well, now compared to the safe rate, which is 3.5, it looks bigger, but that's, remember I just said the 10-year treasury is kind of the basis of all, and we will go through this later. I don't want to go into this today. You're already going to be totally burned out, but we'll walk you through CAPM later. Maybe I'll just do a video on it actually. I'm not going to think about anything less than 7% when I'm thinking about a long-term big capital risky investment. Because remember, I could always put my money in the stock market. Yeah. So this is small compared to the stock market, and it's a big multiple. If it's a bigger multiple, if it's a bigger rate of return, what would happen to the multiple? What would the multiple be here? 10, right? And if the multiple is even lower, we had a multiple of 5 over there, right? What would the rate be there? 20%. Okay. So when we're thinking about multiples, bigger multiples means smaller rates of return and vice versa. Okay. But anyway, might not even want to go there. Just think about multiples. A lot of people just think in terms of multiples. So here's the different multiples we got for these different businesses. Now, one thing you'll do in the competition is you'll parse this list and say, this is a really small business compared to all these. These ones are a long time ago when the market was different and inflation was different. So you'll pare out some of these and you'll shrink this down to what you think are more valid. That's the exact same thing, by the way, that a home appraiser would do. Look for comparable houses in the neighborhood and see what they sold for, and then how do they price the house? Because some houses are big and luxurious and some houses are more modest. So how can we make an apples to apples comparison? You do want to look at houses that are similar, but no house will be the same. So to make kind of an apples to apples comparison, you know what they do? Dollars per square foot. It's kind of like what we're doing here. We're saying like, how much did you pay for every dollar of the company's earnings? And by the way, if you're thinking about stock valuation, do any of you guys watch like CNBC or stuff like that? The stock analysts are coming on and giving. So I actually listen to that sometimes. It's pretty interesting. I take it all with a grain of salt, but smart stock analysts say useful stuff. They talk about earnings multiples, right? Is anybody familiar with price to earnings multiple? How much is the market willing to pay for $1 of this company's earnings? And if they think it's a really hot company, they'll pay more, right? If they think it's kind of a higher risk company, they'll pay a lot less for $1 of their earnings, right? So that's a stock market kind of analog to what we're talking about here. So the method here is really easy. Okay, look, we picked the ones we wanted. I deleted the ones that I didn't like for various reasons. And then I just say, what is the, let me do this. Let me collapse this down. So here's the ones I chose to go with, and these are called the EBITDA multiples. All right, that's the kind of the jargon that you want to use when you're talking about these, the EBITDA multiples. And I just did some kind of summary statistics on them. What's the min, what's the max, the median, mean, and then what's the standard deviation, okay? So here's kind of my statistics. And the middle of that, 6.97, okay, let's just say that's 7. So similar sized businesses are selling for 7 times their EBITDA. Let's value this particular business at 7 times its EBITDA. Which EBITDA? Where's my, oh, I got to go all the way back to the income statement. Basically the current EBITDA, right? So we're the EBITDA right now, because that's what those EBITDAs on the comps sheet are. So we're saying how 7 times EBITDA. Okay, this company's worth 179 million. Oh, okay. What did we get from DCF? It's worth 221 million. Oh, okay. It's kind of an eye-opening, right? That's a lot less. Well, we might say, well, but some businesses traded at higher EBITDA multiples, right? What was the top of our range? The top of our range was 8.6. What I actually did here, what did I do here? Oh, I just said, let's go 1 standard deviation above and below the mean. That's all I did. And then, okay, with a normal distribution assumption, if I go 1 standard deviation above and below, how much of the range of all possible EBITDA multiples am I capturing there? 68%, right? 34% 1 sigma up, 34% 1 sigma down. So we might call this a trimmed range of EBITDA multiples, something like that, right? And that gives me a nice range that I could use with put in a football chart or something like that. And at the low end, this company's worth 143. If we go with the lowest kind of range of the EBITDA multiples of 5.5, if we go with the higher end, it's worth 216. All right, so that gives us a different number. And now we put both of those numbers together. I don't know if I did that actually anywhere. I didn't do that anywhere because I just did the number crunching. I didn't do the presentation, but I will do the number crunching like behind the scenes, not to give it to you, but to when I look at yours, I can say, double check that. Okay, I think that looks good. Maybe do another scenario or something. So I want to kind of instruct you, but I'm not going to hand it to you, right? I want you to do the legwork and sweat it out and figure it out. And of course, the fun part of ACG is what kind of curveball are they going to throw at us this year? But here's what I got to go to the presentation with it, at least for the numbers. Say, okay, yeah, this business is worth between, let's just say like 180 and 220. All right? That's at a crazy range, you think? What did I say here too? I did some scenarios. I got 220 there. I got 232 there. How am I getting all these different numbers? I'm doing scenarios where I tweak. Remember what I said, what's the only number we're really responsible for here? The R, so I tweak the R. Maybe we should go with a little higher whack, maybe a little lower. Let's run multiple scenarios, kind of see what the top and bottom of our estimates is. So DCF gets me numbers between like 220, 230. Yeah, they're pretty consistent because we're not going to make radical changes in that R. It's not like, well, let's value it at 1%. Let's value it at 19%. No, it's going to be a pretty tight range. It's not like we just pick any number, right? We're going to make some small adjustments into the underlying models that give us the WACC and stuff like that. So I got pretty consistent numbers with the DCF, right? And again, that's like based on your financials. If your financials are screwed up, not on me, right? If you guys are cooking the books or something, that's on you, not us. We are taking this income statement as good, as sound.
So based on all of this, we're making, then we look at these, right? The options for the buying.
Yeah, so we're coming out, and I'll be done here, and then we can have some discussion if we need to. You can go home and take some Tylenol. What's that?
I got class.
Oh. This is class today, right? What more important are you going to learn? So we've got DCF says it's worth like, let's say 220 to 230 million, and comps or EBITDA multiple says it's worth like what did I have there? Let's just say 140 to 260. Okay. That's a nice kind of bracket of, okay, where we think this business is worth. If we're buying it, those are the numbers I put down. Okay, so what do you want to pay? If they have a ask price of 240, what are you gonna do? You're gonna walk away, right? They got an ask price of 190. It's like tempting, right? Yeah, we really want to think about that. Then we might want to dig into the assumptions. Right? So if we're selling and the owner's like, you know, I want to retire, but I can hang around for 5 more years. Okay, if you can hang around for 5 more years and somebody offers us 150, no, that's too low, right? That's in the lower range. Somebody offers us 200, we might, oh yeah, we think about that. It might be a little bit lower, but it's in the range, it's fair, right? If the owner needs out to settle a lawsuit or something, we might take 180, right? So it all depends on all those other contingencies. So it's not like this is the number and that's the end of it. This is the beginning of the next step, which is doing the consulting part, because that's what we actually are. We are consultants who have to factor in everything. The numbers part, and like I said, we got to get the numbers right, but then all those intangible things and all the particularities of the scenario, and those can get really complicated and really fun to think about. So that's what you're going to do.